Hi, good morning. Hello, everyone. So today is this is the week two of financial management. So we'll cover financial management in this lecture. So, in this lecture, we have covered the income statement, cost, revenue, and profit. This is lecture two. I am Faiza Raza and from School System. So, let's get into it. So, first of all, we have discussed about pre-class activity, what was accounting, which we have covered in the first week. Then, the activity was conducted to asking the questions about assets. What are assets? Name the classes of assets that we had, and then definition of liability. We have the students has discussed, and the name of the classes of liabilities the students discussed, and then they have listed the four types of assets. They have listed the four types of liabilities as well. Then for this session's learning outcome was understand the meaning of profit, cost, and revenue, understand income statement and its use. Then we have explored the format of computing the income statement. Then we have understood how profit is determined and understood the concept of depreciation. So first of all, like this is important to understand accounting for income and expenditure. So profit is a key objective for most of the businesses. I'm not talking about the non-profit businesses, but most of the businesses are run for profit making. So the key objective is essential for long-term continuation and survival. Then bottom line is a measure of performance success, which gives meaning for other indicators, including price to earning ratio per share, then sales revenue, sales growth, and market share. Then there are some simple definitions. So profit simply means a positive gain generated from business operations or investment after subtracting all expenses or costs. Then the definition of cost is an expenditure incurred by a firm to produce goods and services. Then we have revenues definition is basically the total amount of money brought in by a company's operations measured over a set amount of time. That is the total amount of income generated by the sales of goods or services related to the company's primary object operations. So determining profit. So how can we determine the profit? So first of all, we have sales turnover. So this is basically the format. No, the some of the formulas. How if there is no sales turnover in the exam purpose. Basically, I'm discussing that if there is no total sales given, so there should be quantity sold and selling price given to you. So how you can find out total sales of the sales turnover? You should multiply quantity sold with the selling price, and then you can find out the total goods and services, and then other income is basically interest or dividend received. Then tax rebate is also the other income. Then cost of making product, service, and cost of sales are one type of cost, and then there are some other operating expenses, which are basically light, heat, rent, insurance, salary, and pension, etc., etc. So the income statement. So income statement is one of the main financial statements. The income statement is subject to generally accepted accounting principles, which is a UK regulations body and international financial reporting standards. So this is an international regulatory body for accounting procedures. So income statement, the formula wise income statement is like profit for the period equals to total revenues for the period minus total expenses incurred in generating that revenue for the period. So what is how statement of financial compared to income statement is basically the statement of financial position reports the wealth of an entity at a moment in time. So income statement reports the flow of wealth over a period of time. So the profit generated by the income statement in the end of the year, it goes to the equity part of the statement of financial position. So this is why these both are interlinked. So then the income statement, there are three parts of income statement. First is gross profit, then operating profit, and then profit for the year or for the period or net income. So one by one we'll discuss about these. So this was the activity which we have conducted in the class. So here you can see that this is a profit and loss or income statement for the year ended 31st of March. So in this business, you can see there is like two types of you can say products. Like there is basically this is an hardware business. So in this business they are doing they are selling hardware, also they are providing consultancy as well. So for this reason, we've discussed that for consultancy what should be the cost of sales. It would be the direct labor, okay, because the person who is providing the service is basically the direct labor for that service. So for hardwares we have cost of goods sold separately, and for consultancy we have direct labor separately. So then after deducting cost of sales from sales, we got gross profit, and then after deducting all of the overheads like salaries, car and travel and legal fees and etc etc, so all of the overheads we have deducted from gross profit, and then in the end we got profit and loss. uh, then this was another in-class activity we have done. Okay, analyzing costs. So how there are three main considerations while analyzing the costs. First is quantification. So it is how much is the cost you need to identify. Then allocation. So allocation is very important in a way that it should be properly allocated in is it direct cost, is it indirect cost, is it variable cost, or is it fixed cost. So these are basically the heads where the cost should be allocated properly. It is recorded as cost of sales, operating expenses, or exceptional items. So then recurrence is means like is this cost is coming again and again, or is it like happening again and again? So this determines where on the income statement this item will be recorded. Then accounting conventions. We have discussed accounting convention. Here is like basically the realization concept. So the realization concept is a convention that revenue and costs are recognized as they are earned and incurred, not as cash is received or paid. And they are matched with one another, the matching concept, and dealt with within the income statement of the period to which they relate. So this is basically accruals convention where used where appropriate. So these are some accounting concepts. Business entity concept is like a business entity concept is like a business and its owner should be treated separately as far as the financial transactions are concerned. Then money measurement concept is like basically only business transactions that can be expressed in terms of money as recorded in accounting, though records of other types of transactions may be kept separately. Dual aspect concept is like for every credit, a corresponding debit is made. The recording of a transaction is complete only with this dual aspect. Then it's not like every transaction should be having minimum dual aspects, but it can have more than dual aspects as well. So then going concern concept is like you should always consider that the business will continue processing for the foreseen future. Then cost concept is like the fixed assets of a business are recorded on the basis of their original cost in the first year of accounting. Subsequently, these assets are recorded minus depreciation. No rise or fall in market price is taken into account. The concept applies only to fixed assets. So accounting year concept is basically each business chooses a specific time period to complete a cycle of the accounting process. For example, it can be monthly, it can be quarterly, or it can be annually. So Matching concept is like this principle dictates that for every entry of revenue recorded is a given accounting period, an equal expense entry has to be recorded for correctly calculating profit or loss in a given period. And then last but not the least, realization concept is according to this concept, profit is recognized only when it is earned. An advance or fee paid is not considered as profit until the goods or service have been delivered to the buyer. Then, what is the depreciation concept? So, depreciation is referred as a reduction in the value of the asset over its useful life due to a wear and tear. So, then is it this is basically the international accounting standards 16 act defines that depreciation as the systematic allocation of the depreciable amount of an asset over its life. So it is basically depreciation is basically for non-current assets have a finite life, get used up, physical deterioration and obsolescence can be seen. So that's why depreciation concept is applied. Then it measures that proportion of the cost fair value of a non-current asset that has been depleted in generating revenue in a given period of time, and it is associated with amortization. This refers specifically to intangible non-current assets. So there are two methods of calculating the depreciation, which is straight line method and reducing balance method. So in both of the methods, we need some of the figures, which is like cost. We should be known that what is the actual or fair value of the asset, then useful life, how much can be its useful life, and then residual value, we should be known. Then uses of the income statement we have discussed, which was like it provides information on how efficient the business has been in generating profit from its inputs, and then provides information on how the profit was made. So that was the end of the lecture. So this was the week 2 post-class activity. By this activity, we have ended the lecture, and thank you so much for listening and being with me. Thank you.